$34,500. That's the number on the contract in front of you. You've been at this dealership for 3 hours. You did your research, you pulled the invoice price, you negotiated hard. You know exactly what this car cost them to buy, and you got it for $50 above that number. The salesman shakes your hand. He smiles. He says, "You really know your stuff." You drive home, thinking you won. Here's what you don't know yet. By the time that handshake happened, the dealership had already made $3,200 on you. And if you walked in and said those 3 words, "I'm paying cash," they made $2,400 more than the guy who bought the same car, same day, same price, same car, same dealership, same Tuesday afternoon. Different life. Today, you're going to see exactly how that happened, all 14 layers of it. And then you're going to know what to do instead. Here's the thing nobody tells you before you walk onto a lot. A car dealership is not a car business. It is a financial services business. The car is just the reason you came in. What they've spent decades engineering every room, every handoff, every friendly smile, is designed to extract money from you in ways you can't see, at a moment when you're tired, emotionally invested, and just want to be done. Most people focus on the sticker price. That's the number they argue about. That's the battlefield they think matters. It's not. There are 14 profit layers built into the average car deal. Most buyers pay all of them. The ones who don't, the ones who leave the lot with the same car for thousands less, aren't smarter. They're not better negotiators. They just knew what they were walking into. That's what the next 17 minutes is going to do for you. Let's start with what you think you know. You've done your homework. You pulled the invoice price from Edmunds or Consumer Reports, the number the manufacturer charged the dealer. On a $32,500 car, let's say that invoice is $29,900. You negotiate from $32,500 down to $29,950, $50 over invoice. You feel like you got the dealer down to almost nothing, like you squeezed every dollar out of the deal. Here's what you don't know yet. That invoice number is not what the dealer actually paid. Behind every car sale, there are payments flowing from the manufacturer back to the dealership, payments that never appear on any document you'll ever see. The invoice is the starting price of a negotiation between the manufacturer and the dealer. It is not the dealer's cost. First, dealer holdback. After the dealer buys a car at invoice price, the manufacturer quietly rebates 2 to 3% of the total list price back to them. Not the invoice price, the sticker price. On a $32,500 car, that's $650 to $975 deposited quarterly, invisible to you, guaranteed before you ever walked through the door. Second, dealer cash incentives. When a manufacturer needs to move a specific model, maybe it's not selling fast enough, maybe a new version is coming, they pay the dealer a bonus for every unit sold, sometimes $500. Sometimes $2,000. The dealer does not have to pass this to you. Most don't mention it. It simply disappears into their margin. Third, volume bonuses. Sell 50 cars this month. The manufacturer sends a check for $150,000. Sell 60, it's $250,000. This changes how a dealer thinks about every single transaction. You're not just a customer, you're a data point toward a threshold that unlocks a bonus your transaction helped trigger. That $50 above invoice deal you negotiated? The dealer made over $1,200 before you signed a single page. And here's the part that should stop you cold. That's still not where the real money is. The real money isn't on the sales floor at all. It's in a room you walk into after you think the negotiation is already over. After you agree on a price, you get handed off to someone new, the finance manager, clean desk, family photo. He's going to help you with the paperwork. He's the friendliest person you've met today. He's also the most expensive. Here's what the public financial disclosures of major dealer groups show. The average front-end gross profit on a new car, the difference between invoice and sale price, is around $3,200. But the average net profit to the dealer after paying their sales staff and overhead? Between $500 and $1,200 per car. The finance manager's office generates between $2,000 and $2,800 $800 per car. The car sale, by itself, barely breaks even. The finance manager's room is where the dealership actually makes money. Here's what's inside it. Loan reserve. If you're financing, the finance manager submits your application to multiple lenders. A lender approves you at 6.9%. The finance manager quotes you 8.4%. That 1.5% markup, called the loan reserve, is split between the lender and the dealer. On a $30,000 loan over 60 months, that difference puts $600 to $800 in the dealer's pocket. It looks like your interest rate. It's actually a hidden commission. He'll offer you a vehicle protection plan, a comprehensive coverage package that gives you peace of mind. The dealer's cost for that plan, approximately $400. Their selling price, $1,500 to $2,500. That's a 300 to 500% margin sold to you at the exact moment you're most mentally drained and most motivated to just sign and leave. This one is actually worth considering. It covers the difference between what you owe on the car and what your insurance pays out if it's totaled. The dealer charges $400 to $900 for it. Your auto insurance company charges $20 to $40 per year for the same coverage, same product, 20 times the price. Paint sealant, fabric protection, wheel and tire coverage. The dealer pays $50 to $150 to apply these. They sell for $800 to $2,000. You will almost certainly never use them. By the time you leave the finance manager's office, if you didn't know what you were walking into, you've added $2,000 to $2,800 to the cost of that car, and it all felt like standard paperwork. Now, let's talk about what happened when you said, "I'm paying cash." Here's what the finance manager heard. No loan, no reserve, no markup on interest, no $700 commission from the lender. That $700 to $800 just disappeared from his projected income on your deal. And finance managers are paid heavily on commission. So what does he do? He adjusts. He finds it somewhere else. He holds firmer on the dock fee. He's less flexible on the trade-in. He pushes harder on the extended warranty. He makes up the difference and then some. This is not conspiracy. This is math. And when researchers analyzed thousands of dealer transaction records, the pattern was consistent. Cash buyers paid an average of $2,400 more on their out-the-door price than buyers who came in with outside financing. You didn't walk in weak. You walked in with money, but you handed the dealer information they used against you before you realized the game had started. Here's where the two paths split. You cash buyer, fully prepared, paid $29,950 for the car and another $2,400 in adjustments you didn't see coming. Total out the door, somewhere north of $34,000 when fees are stacked. The informed buyer who walked in with a pre-approved loan from his credit union at 5.8% negotiated the same $29,950 price. The dealer saw a finance deal on the horizon. They gave ground on the front end because they expected to earn on the back. He reviewed the F&I products calmly, declined most of them, and left with a loan he paid off in 30 days. Interest paid, less than $50. Savings compared to you, $2,400. Same car, same price on paper, different sequence of information, different life. The counterintuitive truth is this. The most expensive thing you can do at a car dealership is eliminate the dealer's ability to make money on financing before you've already locked in your price. Give them the financing opportunity. Negotiate from that position. Then take control of the payoff. Here's exactly what you do instead. Step 1. Get pre-approved before you arrive. Walk in with a loan offer from your bank or credit union. Know your rate. This is your anchor. The dealer will try to beat it. Let them try. The point is that you have a number and you control the conversation. Step 2. Never reveal your payment method until after you've agreed on a price. When they ask how you're planning to pay, say you're open to financing. Nothing more. Don't mention cash. Don't mention your pre-approval. Not yet. You want them competing on price, not recovering finance losses in the price. Step 3. Negotiate the out-the-door number, not the monthly payment. Monthly payments can be stretched across 72 months to hide a bad deal. Get the total price first. Everything else is downstream of that number. Step 4. Know the real invoice, including what you can't see. Tools like CarEdge and Edmunds True Market Value will estimate dealer incentives and holdbacks in your area. Walk in knowing the actual floor, not the floor the dealer wants you to think exists. Step 5. In the finance manager's office, say no to everything first. Let them present every product. Write down each one. Tell them you want to review overnight. Watch the prices drop sometimes by half. If you want gap insurance, buy it from your auto insurer for $20 to $40 a year. If you want an extended warranty, compare third-party providers before you sign. Step 6. After the final price is locked, then pay cash or pay off the loan within 30 days. You gave them the finance opportunity. You negotiated the full price with that in play. Now you close it out on your terms. You've paid almost nothing in interest. You've kept the $2,400 in your pocket. This isn't adversarial. This is informed. The dealership has had 40 years to engineer this process. You've had the last 16 minutes to understand it. That's enough. The car hasn't changed. The price on the window hasn't changed. What changes is the sequence of information and who controls it when you walk through that door. Now you know what's actually being sold in that building. You know which room costs the most. You know why cash is a liability until the moment it's an asset. And you know exactly what to do about it. See you in the next one.